When a country runs out of money, it has very few places to turn. Banks won't lend to a bankrupt government. Other countries attach political strings to their aid. And so, desperate finance ministers board planes to Washington, D.C., walk into a glass building on 19th Street and ask for help. The International Monetary Fund says yes, almost always. But the money comes with a list, not a short list, a detailed, specific economy reshaping list of conditions that will determine how that country runs its schools, prices its electricity, pays its workers, and structures its entire economic system. And most citizens of that country will never know this list exists. Today, we are going to examine exactly how the IMF operates, what it actually demands in exchange for its loans, and why some of the world's most respected economists argue that its conditions have caused more harm than the crises they were meant to solve. The International Monetary Fund was created in 1944 at the Bretton Woods Conference in New Hampshire, United States. 44 nations gathered to design the post-war global financial system. The IMF emerged from that conference with a stated mission to ensure stability in the international monetary system and help countries facing balance of payments crises. Today, it has 190 member countries, but not all members are equal. Voting power in the IMF is determined by financial quotas. The more money a country contributes to the IMF's funding pool, the more votes it controls. The United States holds approximately 17% of total voting power. Major decisions require 85% approval. This means the United States holds effective veto power over every major IMF decision. The next largest shareholders are Japan, China, Germany, France, and the United Kingdom. Together, the wealthy Western nations and their allies control the majority of IMF decision-making. The countries most likely to borrow from the IMF, the developing and emerging economies of Asia, Africa, and Latin America, hold minority voting shares. This structural reality shapes everything that follows. When a country approaches the IMF for a loan, it enters into a process called an Article IV consultation, followed by program negotiations. The IMF sends a team of economists to assess the country's economic situation. They examine the fiscal deficit, current account balance, inflation rate, debt levels, and foreign exchange reserves. Then they propose a program. The program has two components. First, the loan itself, dispersed in tranches over months or years. Second, the conditions attached to that loan, formally called conditionality. These conditions are documented in a letter of intent signed by the borrowing country's government and submitted to the IMF board for approval. This letter is legally binding. Miss the conditions and the next tranche of funding is withheld. The conditions attached to IMF loans fall into several categories that have remained remarkably consistent across decades and across countries. Fiscal austerity. The IMF almost universally requires governments to reduce their budget deficits. In practice, this means cutting government spending. The areas most frequently targeted are subsidies on food and fuel, social welfare programs, public sector wages, and infrastructure investment. In Pakistan's current IMF program, electricity subsidies were removed, resulting in dramatic increases in electricity bills for ordinary citizens. This was a direct IMF condition documented in Pakistan's letter of intent. Privatization. The IMF frequently requires governments to sell state-owned enterprises to private investors. Airlines, utilities, telecommunication companies, and banks have been privatized across dozens of countries under IMF programs. In Argentina during the 1990s, the IMF supported extensive privatization of state assets. Water systems, telephone networks, and energy companies were sold, often to foreign investors, as conditions of continued IMF support. Monetary tightening. The IMF typically requires central banks to raise interest rates and restrict money supply growth to control inflation. While this can reduce inflation, high interest rates simultaneously make borrowing expensive for businesses and consumers, slowing economic activity and increasing unemployment. Trade liberalization. IMF programs frequently include requirements to reduce tariffs and open markets to foreign competition. While free trade has genuine economic benefits in theory, rapid trade liberalization can devastate domestic industries unable to compete with cheaper foreign imports, causing unemployment and industrial decline before any long-term benefits materialize. Currency devaluation. Countries are often required to allow their currencies to fall in value. While this can boost exports, it simultaneously makes imports more expensive, increases the real value of foreign currency-denominated debt, and reduces the purchasing power of ordinary citizens. These are not abstract economic policies. They have documented human consequences. Joseph Stiglitz, former chief economist of the World Bank and Nobel Prize winner in economics, resigned from his position partly in protest at IMF policies. In his book Globalization and Its Discontents, he documented how IMF structural adjustment programs in East Asia during the 1997 financial crisis turned a manageable currency crisis into a devastating economic collapse. The IMF required countries like Indonesia, Thailand, and South Korea to raise interest rates and cut spending during the crisis. Stiglitz argued this was precisely the wrong medicine, deepening the recession, causing massive unemployment, and destroying companies that could have survived with different policies. In Indonesia, the economic collapse contributed to political instability in the fall of the Suharto government. 30 years of economic development was set back significantly in a matter of months. In Greece, following the 2008 financial crisis, IMF and European creditor imposed austerity resulted in a 25% contraction of the Greek economy, unemployment exceeding 27%, and significant deterioration in public health outcomes documented by medical researchers. The IMF itself later conducted an internal review, acknowledging that it had underestimated the negative economic impact of austerity measures in Greece. That acknowledgement came after the damage was done. What makes IMF conditionality particularly significant is its consistency across different countries in different decades. Whether in Latin America in the 1980s, East Asia in the 1990s, Eastern Europe after the Soviet collapse, Sub-Saharan Africa throughout multiple decades, or South Asia today, the policy prescriptions have been remarkably similar. Cut subsidies, privatize state assets, raise interest rates, open markets, reduce government deficits. Critics, including Stiglitz, economist Joon Chang, and researcher Naomi Klein, have argued this consistency reflects not neutral economic expertise, but a specific ideological framework that favors open markets, foreign investment access, and reduced state intervention. Joon Chang has pointed out that the conditions the IMF imposes on developing countries are conditions that wealthy nations themselves never followed during their own development periods. The United States used extensive tariffs and industrial policy during its 19th century industrialization. Germany, Japan, and South Korea all developed behind protective economic walls before liberalizing. The conditions that built wealthy nations are conditions the IMF prevents developing nations from using. When a developing country removes subsidies, privatizes assets, opens its markets, and raises interest rates, specific actors benefit from these changes. Foreign investors gain access to assets previously owned by the state. Privatized utilities, telecommunications networks, and financial institutions are frequently acquired by international corporations and investment funds. Creditors are repaid. IMF loan conditions prioritize debt repayment to international creditors, ensuring that foreign banks and bondholders receive payment even as domestic social spending is cut. Import-exporters in wealthy nations gain access to newly opened markets. Trade liberalization conditions remove barriers that previously protected domestic industries in borrowing countries. This does not mean IMF programs never help borrowing countries. Currency stabilization, inflation control, and restored market confidence have genuine value. Some IMF programs have contributed to economic stabilization and recovery. But the question of who bears the costs and who receives the benefits of IMF conditionality is a legitimate and important one that deserves honest examination. Pakistan has entered IMF programs repeatedly throughout its history. As of 2024 and into 2026, Pakistan is operating under an IMF Extended Fund Facility program. The conditions of Pakistan's current program are documented in publicly available letters of intent on the IMF website. They include energy price increases, tax revenue enhancement measures, reduction of the fiscal deficit, and structural reforms to state-owned enterprises. The electricity price increases experienced by Pakistani households in recent years are directly connected to IMF program conditions requiring removal of energy subsidies. This is not speculation. It is documented in official program documents available to anyone who reads them. Whether these conditions are ultimately beneficial or harmful to Pakistan's long-term economic health is a legitimate debate among serious economists. What is not debatable is that these conditions exist, that they are imposed as requirements for receiving loans, and that they directly affect the daily lives of ordinary Pakistani citizens who have no knowledge of or voice in the negotiations that produce them. The IMF presents itself as a neutral technical institution providing economic expertise to countries in crisis. The reality is more complex. It is an institution with a governance structure that gives dominant voice to wealthy creditor nations. It attaches conditions to its loans that consistently follow a specific economic policy framework. Those conditions shape the economic policies of borrowing governments in ways that affect hundreds of millions of people. Understanding this does not require believing in conspiracy theories. It requires reading the IMF's own documents. The letters of intent are public. The voting structures are public. The economic research on program outcomes is public. The information exists. Most people simply never look for it. That is what this channel exists to change. If you found this analysis valuable, subscribe to The Business Architect. Every week we examine the hidden financial mechanisms and power structures that shape the world most people never see. The next video will go even deeper.